Fed on one hand, corporate America on the other. What should investors do about this divide? Joining me now are Subhadra Rajappa, SocGen's head of U.S. rate strategy, and Julia Coronado is Macro Policy Perspectives president and founder. It's great to have you both here. And Julia, I'll start with you because I don't think you're in the inflation camp. Tell me why you think these price pressures will prove fleeting and how fleeting.
Well, there's a difference between inflation, which is year after year increases in prices, and a one-time pass-through of supply chain pressures, which we do expect to see some of, and the Fed expects to see some of. But if you're going to see prices rise year after year after year, that's inflation. That tends to have to be not just supply chain driven or commodities driven, but a broad-based phenomenon that comes with broad-based wage gains. So that's the more salient question for the Fed in terms of thinking about inflation. And remember, they expect a pop in inflation this year. The question is, will it be repeated next year and the year after?
Yep.
And then also keep in mind, Kelly, they want to achieve somewhat higher inflation. So if we do get a higher run rate, that's exactly what they're trying to get.
Yeah, and Subhadra, that's why we always look to the bond market for kind of keeping us honest. And it does not seem to be suggesting big, lasting inflation pressures. To Julia's point, it says, okay, maybe we're going to get up to 2%, but even the 10-year is not there yet. Maybe we won't on a lasting basis. It's amazing to me because we're going to hear from the president tonight announcing this, plan that's part of Build Back Better. We're talking about $4 trillion spent by Congress last year. We've got so far, I think, about $6 trillion announced in Build Back Better. A little bit of pay for, Subhadra, but why are bond yields so unmoved by either the cost pressures we're talking about or some of the spending side on the spending side of the fiscal package? Why are they just shrugging it off here?
So the higher inflation is being borne out very clearly in the inflation expectations market, i.e. the TIPS market, where 10-year break-evens, for instance, are at 240, above 240 right now. It's really the highest level inflation break-evens have been in the last decade. Yes, 10-year yields are still quite low on an outright basis, just above 160 right now. But, a lot of the recent rally, what was interesting in the bond market is the rally was entirely driven by a decline in real yields. And inflation break-evens actually widened. Why? Because there's pressures in the exact, commodity prices are going up. It's exactly the same issues that the CEOs are pointing out to, which is supply-side disruptions leading to higher commodity prices. And that's leading break-evens wider.
Shepard Smith here. Thanks for watching CNBC on YouTube.